Hello and welcome to your fourth financial class. This is Investing 101. This is the fourth in a series of classes in Investing 101. So check out the playlist to see past and future classes in the same course. Today we're going to be talking about tax brackets, retirement accounts, and specifically about the differences between pre-tax, after-tax, and Roth contributions, and your W-4. And this is all very important because when you're investing, you have to make sure that you're compliant with tax laws. And there's a lot of strategies you can use to minimize your tax liability. We'll talk about some of those, but mostly you should absolutely talk to a tax professional when you're talking about big change where knowing strategies can make a big difference on your tax bill. But we'll give you some ideas of how to tell when that's true. So we'll talk about tax brackets. You will identify what your marginal tax rate is as opposed to your average tax rate and what that means to you. And we'll use a spreadsheet to help with that. So this is a simple spreadsheet that I put together. It has actual tax brackets for the 2022 year for married filing jointly. There might be some other conditions into which tax brackets I chose. The point is not to remember these particular numbers. We're using this as for educational illustrative purposes, okay? So let's start by assuming that you made $35,000 this year, okay? Now, the standard deduction is a generous $25,900, which means that if you've made $35,000, you only have to pay tax on $9,100 because you get this as a freebie. Now, it turns out that the tax brackets being what they are, your first $13,000 of taxable income has a tax rate of 0%, meaning your tax liability for that $9,100 is zero, which brings your total annual tax liability to zero. That's great. So if you're making $35,000 a year, you're tax-free. And this, by the way, is focusing on federal income tax. Not saying anything about state income tax or Social Security or any of the other taxes that might apply to you. File a tax return, all that good stuff. But we're just talking about numbers here. You don't owe any tax in this case for federal income tax. And let's raise it up a bit. Let's say you earn $50,000. Now this gets more interesting. So you still get the standard deduction, but now your taxable income is high enough that your income spills over from the first bucket into the second bucket. So you actually are paying taxes based on two buckets. The first bucket, which was from $0 to $13,000, is full, which gives you $11,100 spill over into the next bucket, which goes from $13,000 to $20,550. You don't fill the second bucket, but of this amount of money that goes into the second bucket, you owe 10%, which means that you have a total tax liability from this bucket of $1,110, and that is the only bucket in which you owe taxes, so that is your total tax liability for the whole year. Now, what does this do to your paycheck? Well, you were going to make $50,000 a year. That's your gross income. After taxes comes out, you're left with $48,890 in a year. Monthly, you would have gotten a $4,100.66 paycheck. But your employer, I'm going to speak mostly in terms of being employed by an employer. If you're self-employed, a lot of these same numbers still apply, but the process is a little different. Your employer was withholding from your paycheck. If you had a monthly paycheck, it would normally be $4,100, but they withhold $92.50 and give that straight to the IRS, leaving you with a monthly paycheck of $4,074. Now, if there were no other complications, then the exact amount of money is being withheld, and when it comes time to file your tax return, you find out that you don't owe any taxes and you're not getting any taxes back. Things are rarely this simple, but that we'll assume that they are simple because the point of the spreadsheet and learning about marginal and average tax rates is not going to go and drill into those details. But let's take a look again. What if you earned $1 more? That dollar would be taxed at the 10% bracket. 10% rate because the marginal dollar would go into this bucket. So your marginal tax rate is 10%. What is your average tax rate? That is 5%. Just based on your total tax liability or your total taxable income and how much taxes you're actually paying. So it's basically the spread of the tax brackets that you are a part of. So you're paying 5% in taxes. And we're not even including your standard deduction. You're actually spending, paying less than that if we were considering this as your total. Now, let's raise the bar a bit more, shall we? Let's say 100,000. So now things get a little more interesting. Now you're spread across 3 tax brackets. Your total tax liability for the year is almost $7,000. Your marginal tax rate is 12%. So every dollar you earn, every additional dollar you earn is taxed at 12 cents per dollar. On average, for all of your taxable income, you've paid 9 cents per dollar for federal income tax. Okay? Now, I want you to notice that no tax bracket was 100%. So you always get to keep some of each additional dollar you earn. I have seen or heard people talk about, well, I've given money away so that I can get into a lower tax bracket. What they're talking about is by giving away money and itemizing your deductions, you raise this number, which makes your total taxable income lower, which would indeed potentially, now this person probably wouldn't give away $40,000 to get out of this tax bracket. So let's create another scenario here. Let's get you slightly into the next tax bracket. That's probably too much. Okay, so let's say you earned $130,000 a year and you gave away $7,500 and you were itemizing for whatever it is. And so your deductions now go to $34,000. Now we just got out of that tax bracket, okay? What was your net pay after that change of giving away some more money? Now it's $120,000. Before we gave away that extra money, what's your net pay? $118,000. But that's just a deduction. So we have to consider, so by raising the deduction, you got $120,000, but remember you gave away $7,000, which isn't accounted for here. So your net pay minus your actual contribution brings you down to $114,000. So getting out of this tax bracket and getting back up into this one didn't actually make you more money. What I'm getting at is every tax bracket represents money that is taken away, but you always keep some of it. So by giving away all of the dollar, yes, you're reducing your tax liability, but you didn't walk away with more money. So it does not make sense to give away money or earn less in order to get to a lower tax bracket. I believe this is a misconception from a misunderstanding tax brackets. If you're in the 22% tax bracket, that does not mean your average tax rate is 22% and that by getting rid of $7,000, now you're only paying 12% in taxes. That's not the case. Even for this person who's in the 22% bracket, the average tax rate is only 11%. So by giving up $7,500 in income, you're giving away most of that $7,500. You're not regaining it by being in a lower tax bracket, okay? So that's the difference between the marginal tax rate and average tax rate. They're very different numbers. And the one that matters most to you is the average one. Now, there is another aspect of this, though, which is that it may be advantageous to spread out capital gains to avoid higher tax brackets. So let's take another example here. Let's say it's this, let's adjust this a little bit. Let's go 122,000. So we're almost filled up on this tax bracket here. Okay, it's December, and this is where you're looking like you're going to land. And you're thinking you might want to sell some of your investments, and those investments have appreciated, and you bought them within the last 12 months. Anytime you sell an investment that you've held for less than 12 months, you are taxed. It's called a short-term capital gain. and you're taxed at regular income rates. So it's just considered income. So let's say I sold an investment, and it doesn't matter how much I sold it for. What matters is how much I made by selling it. So let's say I held an investment for less than 12 months and I made a profit of $10,000. And I did this, that would raise this from 122,000 to 132,000. That almost that entire amount of $10,000 in profit was taxed at a significantly higher tax rate than I was at before. A little tiny bit filled up this bucket, but most of it spilled over into this one. Maybe, that's unfortunate that I'm paying a 22% tax rate on that gain, right? So instead, what if I held it? Remember, I suppose that it was December, such that waiting until January isn't a big deal. And let's say, if your income, just hypothetically, let's say your income fluctuates from year to year, and next year you're not expecting to make as much income. So let's say you were expecting to make only 80,000. Okay, now you've got lots of room in this bucket now. So if you, instead of selling and making that $10,000 profit in December, you waited until January to sell, and you made that $90,000 in profit, or $10,000 in profit, that would raise you to 90,000. So let's raise it from 80,000 to 90,000. Now look at that. That same $10,000 profit that you could have sold in December, you waited until January, and now all 10,000 of that stayed in the 12% bracket. What does that mean for you? Well, of the 10,000, you would have spent $2,200 on taxes. Now you only have to spend $1,200 on taxes. So that's great for you. Now, we're not always in that particular situation, and maybe you, your income level isn't going to be any lower next year, so why wait? There's another situation. Let's make up another one. Here we had deliberately chosen to be very, very close to the edge of the bracket. Let's pull back a little bit. Let's go to, let's say you were here, so you still have some wiggle room. Now in December, sure, you could make $10,000 in profit and still be in this lower tax bracket, which is nice. But let's say you were gonna sell an investment and make $40,000 in profit. We'll change this to 142,000. Once again, we're spilling over into the next tax bracket, and hypothetically it's December, and you don't need that full $40,000 in December. Maybe you wanted to sell the investment, but you could afford to sell just half of it. So if we reduce, let's say you only sell half of that investment and you only make $20,000 in December. Now we're back in this nice cozy, we've maxed out this tax bracket and we haven't gone into the next one. Then in January, you go and sell the rest of it. Now remember, the base salary was $102,000. So if we make $20,000 extra in December and $20,000 extra in January, we're still filling up this one tax bracket, not spilling over into the next. And yet, you didn't have to put off getting that extra cash for more than a few weeks. And yet it makes a difference of a couple $1,000s in tax liability. So that's pretty good. Again, you might not always find yourself in that situation, but it's just something to be aware of. When you're selling and making a significant capital gain, that's something to be aware of. Also consider that only applies when you're paying short-term capital gains tax. In other words, you're selling an investment that you've held for less than 12 months. Once you're in long-term capital gain, then you pay a fixed rate. At least right now, the tax laws are, I think it's either 15 or 20%. That's just locked in. You always pay that when you're selling an investment that's grown for more than 12 months. So it doesn't matter. It doesn't affect your tax brackets and income because it's not taxed as income. So in general, that's usually a good move, is try to hold your investments at least for 12 months, both because of long-term capital gains and because if you're selling investments for that you've held less than 12 months, that might be a sign that you are trading too frequently. If you were investing money that you're going to need in the next 12 months, maybe investing isn't the right play for you, because at least most of the high gain investments are volatile enough that if you're planning on selling in the next 12 months, you stand to potentially lose a lot because the market might be on a downturn. There's one last trick, which is if you itemize deductions, consider doing so every other year. Now this is a very, very specific situation where the deductions that you pay, that you claim, are flexible as when you pay them. So a lot of people, I mean, standard deduction is so large, most people just standard deduct probably. But if you do itemize, and that might be because you have a mortgage, I mean, there's several things you can deduct, including mortgage interest at the moment. So if you have a house and you pay a mortgage, itemizing might make sense for you. And that's not something you can itemize every other year because you have to pay a mortgage every month, right? But if you do have deductions that you can make every other year and just make twice as many of them. So for example, if you're used to making charitable donations, tithing to your church or something like that, and you can do it every other year, then suppose, let's just say you itemize and you make and you itemize and take away $50,000 every year from your taxable income. Okay, $50,000 off gives you a taxable income of $72,000. But so every year you get $50,000 off on your taxes, on your taxable income. Now, if you did that every other year instead, then on the other year, like on the years that you do it, on the years that you itemize, you get $100,000 deducted. It's easy, right? 50,000 plus 50,000, you get 100,000. But what do you get on the other years? You get 25,900 off because you can take the standard deduction. Now, over the course of 2 years, you have deducted $125,000 from your taxable income, whereas otherwise you would have just gotten 100,000. So you get $25,000 more tax-free by doing this. Again, that assumes that all of your deductions that you can itemize can shift, and skip a year. And I'm not talking about fudging numbers or fudging dates. I'm talking about literally rescheduling your charitable contributions or whatever these deductions that you take are, literally expensing those deductions on those off years, every even year or every odd year. Just an idea. Again, that might not apply to many of you, but it's an interesting idea for saving $25,000 of taxable income. Finally, Khan Academy is pretty sweet as far as offering free educational materials, including taxes. So if you want to know more about tax brackets, there's, search Khan Academy for tax brackets. You can find some good stuff there. All right, let's talk more about retirement accounts. So we've touched on this before in a previous class. We're going to drill in a little bit further, and we're going to use that spreadsheet to help illustrate the differences between before and after tax, and then we'll talk about the magical power of Roth. So everybody can open up a traditional IRA or a Roth IRA. Not everybody can contribute to them based on income limits, and there are limits, just contribution limits. You can only put so much money per year into these things. Then you have your 401k. If you're employed, your employer might offer you a 401k option. And whereas a traditional IRA you can contribute to it with pre-tax or after-tax money, and we'll talk about that. And a Roth IRA is always just you putting in Roth money, which is a form of after-tax. A 401k is one account, but you can potentially put in one or all three kinds of money: pre-tax, after-tax, and Roth. That depends on your employer. Your employer sets up your 401k and establishes whatever limits or options that are in it. And it's usually at some sort of a brokerage firm like Fidelity or TD Ameritrade or some other bank. My company, I happen to work at Microsoft, offers all three kinds of money as contributions. So I can contribute pre-tax, after-tax, and Roth money to my 401k. And we'll talk about why that's interesting and useful. But my brother has a 401k from his work that does not offer after-tax as an option. It's just pre-tax and Roth, which makes sense, but it's not as advantageous as having all three, again, for reasons we'll talk about. So let's talk about the difference between pre-tax and after-tax to start with. Let's take the same person who makes $122,000 a year, and let's say they want to save for their retirement. Now, we're not going to talk about whether it's a 401k or a traditional IRA right now, but let's just say they wanted to put in after-tax money. So it's effectively They got they get a $9,300 paycheck every month, and from that they contribute enough that they put in $10,000 a year into their after-tax retirement account. Okay, so that drops their monthly income by $833. So literally, the effect of the check that they get every month went down by $133 or $10,000 a year. And that money, that $10,000, is taxed, and they can withdraw it in retirement tax-free, that money. But the growth of that money has not been taxed, and they will have to pay tax on that. So depending on how long you have before retirement, if you've got a long time, and we've shown how like 30 years with an average stock market return can turn into millions of dollars. So in 30 years, you've paid at $10,000 a year, you've paid you've paid $300,000, and now you've got millions of dollars in your retirement account. $300,000 has already been taxed, and you can withdraw that tax-free, but the millions that remain have not been taxed, and you will have to pay. It will be treated as income. When you take distributions from your retirement account, that will be claimed as gross income, and you'll have to pay taxes based on these same tax brackets. Now, we'll get more into that after we talk about pre-tax. Let's focus on the pre-tax versus after-tax for the time. So look at this paycheck. You have $8,500.36 after your after-tax contribution is paid. Okay. And for simplicity, we could even assume, let's assume this is a 401k after-tax contribution. So your employer took this out and you didn't even see the money. Like this is literally what your paycheck said. Let's look at what would happen if you moved the $10,000 to pre-tax. You may have heard people recommend put pre-tax money into your retirement account, not after-tax, because you get more money that way. Well, why? How is that? So remember, 8,536, that's your paycheck size, okay? Now we're gonna move this $10,000 from after-tax to pre-tax. Now look at this. We did have 8,536, now we have 8,636. We got $100 more a month in our paycheck, and we're still saving. That full $10,000 went into your retirement account. That's great. So you get more take-home pay, and you're still saving $10,000 for retirement. What's not to like? Well, it's true. You get more money now. How much of that money has been taxed in your retirement account? Before, you had $300,000 taxed in your retirement account, and millions that wasn't, potentially millions. Now nothing's been taxed. And so there's no money that you can withdraw tax-free. Everything you withdraw from your retirement account when you're retired will be taxed. Again, subject to these tax brackets. So if you live, if you only withdraw, $40,000 a year, assuming the standard deduction, then you won't owe any taxes, and you will truly be tax-free if you live on very little. But if you plan on withdrawing more than that, then you're going to be paying taxes on that. And so that's the difference. Do you want to pay taxes now or later? And if you're making, just to take a really extreme example, let's say you're making $250,000 a year. Your average tax rate is 17%, but your marginal tax rate is 24%. Now, here, this $10,000 didn't get taxed at all. If it was over here, it would be taxed at what? Here's a homework question for you, okay? But think of it now. If I move this here, what will the tax rate be on that $10,000? Will it be 17%? Or will it be 24%? It's going to be 24%. Because remember, that's the marginal. Every additional dollar you earn. If we move this down, that full amount just went into this bucket, this bracket, because the money just wasn't taxable before, and now it is. So you're paying 24% on that. That's a lot of money to pay, 24% on that $10,000. And again, you're putting $10,000 of after-tax money in. So that extra $2,000 a year didn't come out of your retirement savings, that came out of your paycheck. So you're getting less money per month. So this person who makes $250,000 might decide, well, when I retire, I'm going to be living off of $80,000 a year because I won't have kids. I won't be paying for their college. I will be living in a smaller home. I'll be living in a lower cost of living area instead of in this expensive metropolis where I work. Like, there's all sorts of reasons to believe that your costs might go down. Now, it might also go up because of health costs and other things. It depends on your lifestyle, your health, what you want to do. So again, as we talked about in a previous class, you should decide how much you need in retirement. And let's say this person expects to need $80,000 a year. Well, we put this back in pre-tax money and make $80,000 a year. Instead, that $10,000, instead of being taxed at 24%, is now getting taxed at 12%. That's a much, in general, like you didn't pay tax now, you paid tax on it later when you were in a lower tax bracket. That's great. So that was a smart move on that person's part. Pre-tax can make a lot of sense when you think you're going to be in a lower tax bracket in retirement than you are now. It also makes sense if you are planning on being very philanthropic. Let's say you expect to have many millions of dollars in your retirement account, more than you ever need in retirement. That would be a nice position to be in. And frankly, depending on how long you're investing, is actually a very real possibility. So pre-tax, you haven't paid tax on it. If you withdraw that money in retirement and give it away to some 501c3, which is the US's designation for places you can give money to and then write it off your taxes. So if you could withdraw $250,000 a year in your retirement and deduct everything but $180,000 or $80,000, which you're going to live off of. So that leaves you with $170,000 or to deduct. Now you're still in that low 12% tax bracket, and you got to give away a bunch of money that you never paid tax on, ever. You never paid tax on this $10,000 while you were working. And when you withdrew tons of money in retirement but gave most of it away, that's also not taxable. So you helped that museum or that church or whatever it is you like to, or the veterinarian hospital, whatever you wanted to give money to, that was a 501c3 with totally tax-free money, which is a great way to go. Now, if you wanted to give your money to your neighbor, the government does not recognize that as a charitable contribution, and you'd have to pay tax on the money you give to your neighbor. So let's talk about the third kind of money, which is Roth. In a Roth, it is after-tax money. Let's go back to some sane number here. Bring back the standard deduction. There we go. Now, instead of $10,000 in pre-tax, I said that Roth is a form of after-tax, so we have to take it out over here. So you did pay tax on it when you put it in. The difference is with an ordinary after-tax, while you can withdraw this money in retirement tax-free, the growth from that money hasn't been taxed and you have to pay tax on it. In Roth, you don't have to pay taxes on the growth. This is absolutely amazing because, as I said, you can end up with many millions of dollars in your retirement account if you've had a long time for that compounding interest to work for you. And those millions are now tax-free. You don't have to pull it out slowly in order to stay in lower tax brackets. You could live it up. You could withdraw several $1 million in 1 year and not owe a penny in taxes because it was inside of a Roth. You could, now maybe you think, well, I don't want to live it up. I don't need $250,000 a year, or millions of dollars a year, whatever it is you could afford to withdraw from your retirement account. That's fine. You could still give it away. Of the millions and millions of dollars in there, you only paid taxes on, say, 300,000 of it, or whatever it was. And so it's not all totally tax-free, but you can give it away. It's your prerogative. And you can give it away to your neighbor and buy him a car when the car breaks down. or whatever it is you want to do. You're not subject to 501c3s anymore, and you don't have to track who you donated to and record that on your tax returns later on. It's a Roth. You can do whatever with that money as you want, which is wonderful. So if a Roth is so good, why would anybody pay after tax or like put it into after tax? Why would they all go into a Roth? That's a very good question. You probably wouldn't, frankly. But a Roth has limits. A Roth has contribution limits. You can only put in a few, several $1,000s a year, and you can only do so when you are employed. Now, those who are self-employed, I don't think a Roth is an option for them, but there's another kind of retirement account that's similar, so that self-employed people have a similar option. So again, I'm just going to focus on the employed people. You have to be employed. You have to put in money that you were paid into the Roth. Basically, if a Roth had a limit of $6,000 a year, you have to have made at least $6,000 a year of taxable income and pay tax on it, and then put that into your Roth. And so, yes, it is powerful. It is amazing what a Roth can allow you to do. Have millions and millions of dollars of tax-free money is amazing. And that's why they limit it severely. All of these have limits. After tax, pre-tax, they all have limits. But Roth is the most severely constrained limit because of its potential for tax-free growth. That leaves the question of what about why then would Microsoft, for example, why would an employer offer after-tax money as well as Roth? And the reason is similar to the tax bucket principle where it spills over. Let's say I have $10,000 to save for retirement. That's more than will fit in the Roth bucket. I don't have the freedom to contribute $10,000 a year into my Roth. So what do? I put it into another bucket. Put it into pre-tax. In fact, diversifying your retirement is a good idea, not just in what kinds of investments you make, but in the kinds of money you put in. So imagine of my $10,000, I put $6,000 in a Roth and fill it up. Legally, all I can put in is $6,000, so I put that in, and then I put $4,000 into pre-tax. Well, what can I do with that? Well, now when I retire, I can live off of my Roth and give away the pre-tax money and have never ever paid tax on any of the pre-tax money because I gave that part away. Or you could put some into pre-tax and remember that how some of that money is free, right? In that spreadsheet, that there's that 0% tax bracket, and then there's a standard deduction and things like that. So you could afford to pull out $35,000 a year in retirement from a pre-tax kind of money and never have paid tax on it, ever. And everything that exceeds $35,000 a year, you would pull out of your Roth account, if you wanted to, and so that you could live a $250,000 a year lifestyle, potentially, having paid tax on only the $6,000 a year while you were working that went into your Roth. Does that make sense? Hopefully so. Okay, so that explains why I would spill over from Roth to pre-tax, but what about this after tax? I still don't understand why after tax would be interesting. Well, there's a legal loophole, called where you roll over your money from, it's a backdoor Roth, as you may have heard it called. You can put money into your after-tax, or you can put after-tax money in, and then ask your brokerage to roll it over into a Roth. So basically, you can fill it. Now, the after-tax has a limit as well, but it's a much higher limit than the Roth limit. So you can contribute and fill up your Roth, you can contribute and fill up your after-tax, and then you can convert your after-tax money into a Roth by paying tax on the growth that you've already had, which if you roll it over frequently, that growth won't be very significant because it just barely went in there in the first place. And in fact, Microsoft, as my employer, the way they've set this up is I can contribute to a Roth, I can contribute to my after-tax, and then within a day of having contributed to after-tax in my 401k, Fidelity will roll it over and convert it into a Roth. So I'll owe a few pennies on the growth for that day, basically, but it's just pennies. So it's effectively like combining the limits of after-tax and Roth and getting one big Roth. Okay. in my 401k, which is amazing. Don't know how long that loophole will remain open legally. We'll see. But in the meantime, it's a great opportunity to capitalize on that. There may even be a way to do that if your employer doesn't offer this option or doesn't offer 401k at all. There may be a way to roll over a after-tax money in a traditional IRA into a Roth IRA. Basically do the backdoor Roth yourself with IRAs. I don't know that for sure, but it's possible. Keep in mind that all of these, again, have limits, both in the amount of contributions you make, and the IRAs at least have limits on your income level. So if you do make a lot of money, it's possible you're not allowed to contribute to these IRAs anymore. Which is a couple things. Be aware of what the laws and limits are, especially for you, because don't just find one website that kind of tells a story and gives you what the limit is, because they change from year to year, and they vary depending on how you file your taxes. Single, married filing jointly, married filing separately, whatever it is. So find out what your limits are. Your brokerage can help you with that often, because they often know at least some of the answers to these questions as they apply to you. Also keep in mind, the contribution limits vary on age as well. As you actually approach retirement age, the IRS has these catch-up limit laws where you can actually contribute an extra $1,000 or something per year because you're close to retirement, and it allows you to catch up because you didn't do it earlier. But whether or not you did it earlier, the catch-up laws apply, so you can contribute more as you approach retirement. The interesting thing, though, is if you start this early, if you're 20 or 30, perhaps, when you start saving for retirement, you won't need the catch-up laws. In fact, the spreadsheet that I'll share in a subsequent class shows me that at some point, I can stop saving for retirement, because the amount of money I would put in is pretty small, relatively small compared to the growth that's already happening every month. And that's going to be a sweet place to get to. And I'll drill more into that in a subsequent class when we show you the spreadsheet. But be aware of all those limits, and that they vary by so many factors, and be familiar with how they apply to you. And just to recap, I kind of summarized why you would want to do pre-tax. And that is, if your taxable income is much higher now than it will be in retirement, then pre-tax probably makes sense, so that you pay a lower tax bracket on that money. If, however, you have a long time before retirement, such that your growth will probably be very, very substantial, and if you're not planning on giving most of that money away to 501c3s, then a Roth totally makes sense. Pay a little bit, because maybe you are in the 24% tax bracket right now, and that's a lot of money to pay on your Roth. It's nothing compared to what it's going to grow into. If your money is 10x or 50x what it used to be, because of the 30 or 40 or 50 years you had before retirement, then so what if you paid taxes on the money you put into your Roth? That's going to be such a large amount of money later. It's effectively tax-free, and there's no other way to do that. It's just incredible. So now let's talk about your W-4s. So a W-4 is something you submit to your employer to adjust the tax they withhold from your paycheck. If you tend to get a large refund at the end of the year, you can submit this to get it closer to zero. You generally want to when you file your tax return, some people get excited about that. Look at the tax refund I got, yay! That's not great. What you gave the IRS was a interest-free loan. You lent them money and they're returning it to you, but they didn't say thanks. They didn't give you interest on that money or anything. So it's not great to get a huge tax refund. You want to have, if you were getting large tax refunds before, you should submit a W-4 to adjust the withholding so that you get closer to zero refund. Now, you don't want to overcorrect, because if you end up owing money when you file your tax return, besides being a nasty surprise, if you owe more than $1,000, that's my limited understanding of the tax law. It might be a little different for you, I don't know, or over time, so don't quote me on the $1,000. But if you owe the IRS too much money, we'll just generalize it like that, there is a penalty. You'll have to pay the IRS extra because they don't like it when you owe them money. And that is why your employer tends to withhold money from your paycheck every month, because they actually send it to the IRS on your behalf so that you don't end up paying penalties. But your employer is basing those withholdings on this spreadsheet. Basically, they have a form of this spreadsheet, and they say, okay, well, you're going to owe $4,500. That's per year. Let's take $376 in taxes a month. So they actually take that out of your paycheck before they give it to you. Okay, that's based on what they believe you will owe in taxes. But if you have a second job, or you have some kind of a side gig where you make some money, or you make a habit of donating to charities and you're planning on itemizing deductions, or your spouse has a job, whatever the case is, your employer doesn't know about the modifications to your taxable income. They don't know what your gross will be, except what they're paying you. They don't know what your deductions will be. And if you're paying pre-tax income into your traditional IRA, they don't know about that either. If you are going through their 401k, they know about it, and they'll adjust your withholding automatically. But if you are contributing to a traditional IRA with pre-tax money, remember the point of doing that was to get a larger paycheck. You won't get a larger paycheck unless you tell them about it. So you file your W-4 and say, these are the deductions that I'm taking, and you would deduct the money that you expect to put into your pre-tax IRA. And then the next month, you get a bigger paycheck from your employer. So a W-4, it should be filled out legally and honestly, but it is also subject to what your personal plans are. Some of the numbers are irrefutable, like how much does your spouse make, how much are you making on the side, and you can do your best estimate on that. Then it's like, what deductions are you going to take? Well, maybe you haven't taken them yet, but you plan to, so you put that in. And then that factors into what the employer adjusts in your withholding. If you get those numbers wrong, it would be a crime if it was fraudulently filled out, but more typically, at least in my case, I just estimated poorly. I didn't realize, for example, that I was going to be selling short-term held asset investments that had a significant profit. So just as a bad story, in 2021, I sold some investments that I did not realize what the cost basis that was going to be considered was. There were some dividends paid. I thought that the cost basis would be the price of that investment at the time, but they were reinvested into that same security. They weren't. The cost basis apparently is supposed to be calculated as zero, which means the profit that I have to report to the IRS is much higher than I anticipated. And also because they were just recently bought as part of a dividend, they were short-term capital gains when I sold them. And so I had significant profit in the short-term capital gain category, which means I was paying a higher tax rate on them. And what I'm discovering now as I'm preparing my taxes for 2021 is I owe a lot more in taxes than my employer thought I would. And so the withholding was not sufficient. And I'm not only going to have a large tax bill in April, I'm going to have to pay a penalty. And the reason for that is I went to my W-4 last year. I told my employer, hey, I'm planning on making some charitable contributions, etc., whatever it is, the deductions, and so you don't have to withhold as much. And so they gave me bigger paychecks, which was great last year, but now I'm paying for it, and it was a mistake. So this year, for 2022, I filed a new W-4, and you can do that as often as you want with your employer. They'll just change a paycheck or two in advance will take into account your new W-4. I filed a new W-4 that said, yes, I do plan on deductions, but we're just going to assume that I am also going to make some profit elsewhere. My wife works a little bit, so I'll consider that, and I'll just assume that I'm going to make X dollars on short-term cap or any kind of capital gain. Like I'm going to make a certain amount of money in profit on the side, so that dramatically increased the withholding my employer is taking out of my paycheck, so that next year, hopefully, I'll be much closer to that zero target and not owe the IRS any money. Now, you could file your W-4 to and claim your additional income in order for them to withhold more money. Another option, if you don't want to tell your employer, not that they probably care, but if you didn't want your employer involved with increasing your withholding on behalf of a different job or a different source of income, you can make your own estimated tax payments to the IRS throughout the year, which will, again, help you avoid penalties and owing taxes at the end of the year. So your homework for today is, if you're working, start saving for retirement if you aren't already saving already. It's not so much the amount that you start saving with, it's that you start now. Remember all the examples we've done about compounding interest. It's about time and the interest rate. And we talked some about the interest rate and how you can actually get it to 10 or 12% or even more by researching different mutual funds. But it's interest rate plus times time. So the sooner you start, the more important. $50 a month for 30 years means $18,000, but that can turn into several $1 million just by the growth, but only if you had 30 years to save it in. So start now. Whatever your life stage is, start now. You can contribute to your 401k if offered by your employer. Try to max out any matching benefit they offer. Many companies will match 50% or something. Microsoft, for example, will if I put in $1,000, they'll put in 500, up to the legal limits of what I am allowed to put in for certain kinds of money. They'll match. And so, as an example, if I put in $18,000, they'll put in $9,000. Beyond that, if I go into the Aftertax bucket, they don't match that. They only match Pretax and Roth, I believe. So there's different limits, and every employer is different. So find out what your employer offers and do your best to max out their benefit, because it's free money. Maybe you lower your lifestyle a little bit now. Maybe you cancel your Netflix subscription, whatever. Stop buying coffee every morning and make your own, whatever it is, to save so that you can max out that employer benefit. Because imagine a 50% return on your investment on day one if your employer matches 50% of what you save. And if a 401k isn't an option for you, or you prefer to do it separately, set up an automated recurring contribution to an IRA account. And finally, if you already are saving, good for you. Review how much you're saving, see if you can bump that up any, and review what kind of money you're putting in. Now that you understand Aftertax, Pretax, and Roth, go back and review the kind of money you're putting in and see if that's still appropriate for you, or if you want to make some adjustments. Thanks so much for watching. Hit the subscribe button to be notified of future videos that give more advice on saving for retirement or reaching your financial goals in other ways. Also check out the Investing 101 playlist so that you can review the past videos, which includes how to research mutual funds, how to get good return rates, and what that can mean to you in achieving your financial goals.